I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Insurance has a huge amount of specialisms that don't always cross over, which means that we can go our whole careers as insurance professionals having a rough idea about what a particular class of business does, but not really ever appreciating the detailed picture. I think trade credit is one of those classes, and that's something we should all fix, not least because it's a product that our clients could probably all benefit from. That's why I'm really glad that an element of this podcast is a useful primer on the class, and that my guest today has one of the biggest single jobs in this line anywhere in the world, and has over 20 years' experience to share with us. Sarah Murrow is President and CEO at Allianz Trade Americas, and what follows is a helpful rundown of this global and really useful class of business. This is insurance in its purest form, risk-taking that allows customers to stick to what they're best at and also improves their return on capital. This is also a line that provides valuable advice as well as a financial product, and is so embedded with its clients that they communicate with it every day. All of us in the rest of the P&C world have an awful lot to learn from trade credit. And as prominent trade credit insurers begin to peer under the Lloyd's platform, this is also a class we should all be getting to know a little better. Sarah is a great guest, and our conversation encompasses themes as broad as global economics and politics, as well as the cut and thrust of insuring trade receivable assets. Listen on and you'll have fun, and you'll also learn a lot. Enjoy the podcast. Sarah, welcome to the Voice of Insurance.
Thank you, Mark. It's a pleasure to be here.
For anybody who doesn't know you, Sarah, why don't you introduce yourself to the listeners and tell us how you got into insurance and run us through your career to date?
So I am currently the president and CEO of Allianz Trade Americas, which encompasses our business units in the US, Canada, and Brazil. I've been with Allianz Trade for 21 years, in fact, which is quite a long journey, especially in today's age, to stay with the same employer for 21 years. But Mark, I've worked with Allianz in 3 different countries, so it definitely feels like I've had more than just one employer. I started right out of university, in fact, with Allianz Trade in Baltimore, Maryland, and spent 12 years in the business here working through various commercial roles, including sales and commercial underwriting. And I ran a broker channel for the US, Canada, and Brazil between 2011 and 2016. Spent a little over a year in Paris. I moved my 1.5 and 4-year-old daughters and my husband to Paris for our first expat assignment in 2016. Spent a year working at our global headquarters as the group head of commercial underwriting and product development, and then moved to London in 2017, where I held the commercial director role for Northern Europe for 4 years, and then most recently as the UK and Ireland CEO from 2021 until just a couple of months ago. And now have returned back stateside following 9 years abroad, and I'm at the helm of the business where I started right out of university. So it's been quite an interesting journey and really happy to be back. A bit of a strange story about how I fell into insurance. I studied international relations and Spanish in university, and I intended to take the Foreign Service exam to work for the State Department. And if you know about that, you take the exam and then you give them your top 3 preferred places to relocate, and then you may or may not get them. Well, in university, I met my then university sweetheart, now husband, and really was not interested in moving abroad right away. So ended up looking for a role with an international company in the Baltimore area. And that's how I found Allianz Trade.
Right.
So that's a bit about my background. So I kind of fell into insurance like a lot of people will do, I guess.
Actually, very similar to me, but I wasn't trying to work for the UK Foreign Office, but I went to my careers department. I did a Spanish degree, a bit like you. And I went to the careers department and said, well, where can I have a job where I speak Spanish? And so I ended up in the London office of a big Spanish insurance broker, and there you are. I suppose you work for a company like Allianz, you are literally in every country in the world, more or less. So the world really is your oyster.
It definitely is. And it really, when I worked for our headquarters in Paris, I had a global role. So I had a bird's eye view of how credit insurance and surety solutions are used across the world. And it's really quite different based off of business culture. And even between, for example, the US and the UK, there's significant differences in how businesses look at credit insurance and why they buy it and why they decide to renew. So it's really just been a fascinating journey.
I suppose sometimes in insurance, we love to put ourselves into different silos. And particularly, obviously, I know the London market very well. And you end up with people who are so specialist that they've kind of painted themselves into a very intricate little cul-de-sac and then there's no way out of it. But they know an awful lot about very little in some ways. So when you're sitting in your wider Allianz group and someone in the rest of the P&C world is asking you, with maybe over a drink after a big offsite or something, how do you describe the world of trade credit to them, to someone who works in property or liability or that kind of thing?
It's a good question, and actually something that I do quite regularly. Within Allianz, we really try and collaborate across business units and across different lines, which provides our customers with more solutions, but also provides them with more holistic insurance coverage, which is overall good for our customers and our brokers. So how I explain credit insurance is this. Very simply, when a business or supplier sells to another business on credit terms, a receivable is created. This is the asset that we underwrite the risk of the customer not paying the supplier. And in the event that they do not pay, we indemnify the supplier. And we then affect our commercial collections activity against the buyer to try and collect on their behalf. Now, it's important to recognize that while credit insurance is a discretionary product, it really should be viewed more importantly by a lot of businesses because accounts receivable is oftentimes the largest or second largest asset on a company's balance sheet. And it's oftentimes the only asset that's not protected by an insurance solution. So it's getting the knowledge out there about credit insurance. And the awareness of credit insurance in the US market is actually quite low compared to some other markets in Europe. For example, France and Germany, credit insurance is a very well-known product that's used by a lot of businesses.
It sounds like that kind of multiplier effect that you get when insurance is really embedded in something. The idea that if you have the credit insurance, you could probably do more business with less capital because they're slightly leaning on your balance sheet, aren't they?
Exactly. So maybe I can talk about why our customers buy our product.
Yeah.
And like a lot of businesses do purchase insurance, the leading reason is for risk mitigation, right? They have an asset, they want to ensure that that asset is protected, so they purchase a credit insurance product. Companies that have really thin margins or businesses that have, for example, significant concentration to one or two customers, which is oftentimes what you see with SME businesses. These types of businesses, they view credit insurance as very valuable because non-payment by a very large customer or non-payment when you're working on very thin margins can have significant impacts to your business. So from a risk mitigation perspective, that's absolutely why a lot of clients purchase our product. But there's also other reasons. Sales expansion or turnover expansion is another key reason. And you don't typically think about insurance being a tool to grow your business, but in fact, with credit insurance, it very much is, because what we allow customers to do is to sell into new countries, for example, or to new customers immediately on credit terms, which they otherwise might not feel or have the risk appetite to do. We also support financing with a lot of businesses, again, very prominent in the SME space. If an SME customer is going to their bank looking for financing, the financial institution will oftentimes say, you need to insure your receivables, and they lend against that asset. And then the last reason is credit management outsourcing. And we see this quite a lot for customers that have large number of suppliers, such as transportation and logistics companies that can oftentimes have hundreds or even thousands of customers. Staffing a credit management team to constantly review the credit of those customers is quite resource intensive, and those businesses can come to us and outsource that solution with our product.
Of course, because you've got a huge database, you're running the credit on nearly every company in the world, so they can avail themselves of that information that you've already got. And you've got credit analysts looking at every company.
Exactly. So very sophisticated models that we have to grade and to assess the risk of over 90 million companies in our risk database globally. We have credit analysts looking at buyers where we have higher levels of exposure, where a more personal touch is really needed, or to help us work out of sensitive situations. And indeed, it's not just the approval of the credit at the start. For example, a purchase order comes in, a customer needs a credit limit approved, they come to us. The value of the product is really in the monitoring of that customer's credit. So if there's a deterioration, we're able to let our customer know that our customer may not be as creditworthy as they were before. They might need to reduce the amount of credit they're extending to protect themselves in the long term.
Right. And of course, I suppose one of the other multipliers is that there's obviously new markets, new customers, but at the same time, you could sell more to the same customer. If you've only got a certain amount of working capital, I suppose your finance department might say, look, guys, we're not going to allow these people to have more than another $200,000 of our stock without paying for it. But if they went to you, maybe they could sell $400,000 worth of stuff to this wonderful customer of yours, and then obviously make more profit. And hopefully the premium is only a small part of that, and you'll be able to grow your business and make more profit.
Mark, it sounds like you could sell our product for us. That is exactly what it is. The credit insurance product can actually pay for itself in terms of increasing sales to existing or new customers. And it's a really strategic business tool for businesses to not only protect their business, but also to grow their business.
One of these myths that's always in my mind is with trade credit, when you get to the point where there is going to be a loss, when everyone knows there's this particular customer Every other week in the UK, a main street household name retailer seems to go bust because we all just buy everything on the internet. We just go into that old faithful retailer, the Woolworths or whoever it is, and then you see the price there, and then the first thing you do is get your phone out and realize you could buy it for £20 cheaper online. And of course, quietly, these businesses with a very high cost base on the high street are all going bust. But there's always that moment. As the insurer, is it a myth in my mind that as the insurer, do you almost effectively trigger a claim on that business to say no more money to Woolworths, for example, which obviously the UK Woolworths is long in the past? Is that a myth that effectively you trigger your own claim?
So we know that we have a significant responsibility to instruct our customers to avoid a loss.
Yeah.
And we understand if, for example, we are supporting significant levels of credit on any particular buyer, we have a responsibility to support our customers carefully. So if we were, for example, to completely cancel all coverage immediately, we could, in fact, trigger an event, which would be irresponsible. And that is not the way that we conduct our business. But we have early warning signs that are usually very early to start coming down on exposure or to start having discussions with our customers about increasing risk and to make them aware.
So it's more about sort of, hey, don't extend. We're going to actually probably be looking to manage this limit downwards because the creditworthiness is not so good, and just be aware. So these things don't tend to come out of the blue. They tend to be chronicles of death long foretold.
Yep, and absolutely. But typically when buyers are having challenges with cash flow, they oftentimes rely on their supplier to help bank their business, right, by extending credit terms or whatever it might be. So you oftentimes see an increase of credit limit requests when buyers start deteriorating a bit because they're looking for their suppliers to help fund their business.
How long's the tail? I mean, it seems relatively short. Would that be correct? And I suppose at some point, of course, when there is a loss, presumably you also get a position where if you've paid a claim, you might be able to later get recoveries on some of those assets.
Yeah, so claims usually arise within 6 to 18 months. So I would say 6 to 12 months more usually of the shipment or the invoicing of a shipment. So the way that policies typically work is the policy is written with maximum terms of payment. So a customer would ship to their buyer on 30, 60-day terms of payment. In the event that there's a non-payment by the buyer, there's typically a period of time, a maximum extension period, where the customer works with the buyer to try and receive payment. In the event that the collection of payment fails at that period of time, then there's a claim filing window. And once the claim is filed, then all documents are into us. We typically pay the claim within 30 to 60 days. And you're right, Mark, recoveries are a major part of our business. So it not only keeps our loss ratio under control if we're able to collect, but it also helps protect our customers by maintaining lower loss ratios going forward, which makes the product more affordable for them. So it's a very positive thing to have strong collections. And at Allianz Trade, we actually have a global collections team, and they are quite significant in terms of protecting our ultimate loss situation.
That's really interesting. At what kind of recovery rate do you build into everything? Because, of course, you have that time factor. Presumably, it takes a long time to get your pennies in the pound or whatever it is, cents on the dollar out of that asset. But then the great thing, I suppose, from the client's perspective is simply they've been paid out. They don't have to worry. They can carry on business as usual. And then this is your problem now, and you can take it on and seek to recover over time. But what sort of time period is that generally? I suppose it must vary depending on what kind of goods or services these are.
It definitely does. So it varies based off of the goods and services. It varies based off of the country in which we're affecting the collections. There are obviously different types of laws around commercial collections activity in different countries. If it's a formal bankruptcy, especially a large bankruptcy, it could be quite prolonged in terms of protecting filing the proof of claim and seeing that through. So it really varies across the board, but our collections team supports those recovery efforts in any of those situations.
It's like a few years, likely.
It could take years. It could absolutely take years. But it allows our customer to continue to run their business without worrying about that.
So tell me about your business, the business that you're running now, Allianz Trade US. What's the sort of scale? I mean, I suppose anything with the word Allianz in it is going to have a reasonable amount of scale, one would expect. It's difficult to know exactly on how you measure it, but Allianz is nearly always the largest insurer in the world, depending on which way you measure it. So it must be a lot of scale. What sort of GWP and what sort of headcount and how many offices have you got? Presumably it's a large operation.
It is a large operation, and I can't give specific written premium numbers beyond what we publish. But what I can say is that Allianz Trade is globally the market leader for credit insurance. And within the US market, we're also the market leader for credit insurance. ICISA, the International Credit Insurance and Surety Association, cites that written premiums globally for trade credit are about 9 billion euros. So just to kind of give you some sizing in terms of the global market, and the US is one of the largest single markets alongside France and Germany, for example. But it's interesting to talk a little bit more about our market. The US business of Allianz Trade dates back to 1893.
Wow.
I know we operated our business quite differently back then, but the same types of solutions that we provide to our customers remain the same. So we're the oldest credit insurer globally, with, again, our roots dating back to 1893. And in the Americas, again, we're the US, Canada, and Brazil. In the US, we have our main office in Baltimore and other offices in New York, Dallas, Chicago, and Miami. In Canada, we're in Montreal and Toronto. And in Brazil, our main office is in Sao Paulo. And we have several hundred employees working for the Allianz Trade Americas operation.
Well, it sounds like with 9 billion just set against the amount of trade there is in the world, it sounds like this is a business that could grow an awful lot. You've got a lot of headroom, haven't you?
Exactly. There is a lot of opportunity. And I talked a little bit about credit insurance in the US in particular. It is probably the most mature market with the lowest penetration rate of trade credit insurance users globally. So we do look at the US as a growth market, ironically, whereas most people view the US as a very mature market. It is very much a growth market for credit insurance, and there is upside. I think the challenge is within the US, it's really education. For example, I did my MBA, and in my financial accounting class, I think there was one page on invoice financing, but I never learned about credit insurance. I think that there's a lack of awareness and a lack of education around the product in the US market. And that's maybe just one of the things that we can do to help expand the awareness about what the product can do.
I learned all about it very quickly. My first journalism job, which was a very, very low rent magazine, every time they invoiced something, they factored the invoice immediately. They sent a fax to Singer and Friedlander, and I got a discount on, whatever, and they take 85% or whatever, they would get 85% upfront. And that's how it all worked, because this was a magazine that had absolutely no money as far as I could see. And eventually it did go bust. It was my first introduction to capital light businesses.
Yeah. And those factoring companies, Mark, all of the invoice finance companies, they all use credit insurance. So they are probably the biggest users of credit insurance globally, because think about it, they're also one step removed from the original transaction between the supplier and the buyer. So inherently, there's an increased risk of non-payment.
As a magazine, we'd already got our cash, so we weren't really controlling credit at that point. That lenders, that would have been their problem, not ours. So what's the mood music in the credit markets at the moment? Obviously, it's a very interesting time economically and politically and everything else. How are you all feeling in terms of where the market is and the quality of credit in the world that's out there that you're looking to insure? How are you feeling about it?
Maybe I can answer this in a couple of different ways.
I mean, it's a big world, but yeah, obviously it's just limited to the US, which is big enough.
Well, maybe I can talk about global growth, and I can also talk about trade forecasts as well as insolvencies, because these are really the key economic indicators that we look at, or that indicate kind of the position or the cycle of our business. And if I was going to sum up the overall situation, I would say under pressure is maybe the catch-all for how we see the current economic situation. So I think in terms of growth, what we see is that global growth will remain sluggish. So we're forecasting 2.5% growth globally in 2025. And this is actually the slowest growth since 2008 outside of recessionary periods. The US in particular has recently been upgraded. The growth forecast is now 1.6%. It was 0.8 percentage points before for this year, but it's been improved due to the lower effective tariffs. So we're having a more positive outview on the US impact as a result of the tariffs than we were previously. Eurozone should see growth at about 1.2%, but this will largely be driven by smaller economies. In Germany, for example, we're projecting 1% growth only in 2026, and that's after essentially flat growth or no growth this year. So a challenging situation. In terms of trade forecasts, this is another KPI that we measure quite closely. Global trade in goods, we're expecting this to grow by 0.3%. And that's really driven by the continued front loading or rerouting that we're seeing as a result of the tariffs, right? A lot of businesses are stocking up on inventory ahead of the tariff effective dates, which is triggering some more positive numbers there. But one of the leading indicators for how we manage to cycle in our business is really around insolvencies. And we're expecting global insolvencies to rise both in 2025 and 2026. So the forecast for this year, global insolvencies are expected to be up 6% and then 3% next year. In the US in particular, the situation is slightly more risky. Insolvencies are forecasted to increase 11% this year and 6% next year. And Mark, all of this is really a result of higher interest rates, tighter financing, and some uneven consumer demands. But supply chains have normalized post-COVID, and certain sectors are rebounding, like tech, driven by the AI boom. So there are some opportunities out there. It's not a uniform picture. I guess that's the summary.
And when the economy is not quite so great, does that raise consciousness around the product is actually kind of good for business in that you have more demand? Although, of course, you will have to charge a higher price.
Indeed. So when everything started shutting down for COVID, I was the commercial director for Northern Europe based in London, and we saw probably the highest conversion and the highest spike in interest in credit insurance than we had seen since the global financial crisis. So absolutely, a lot of businesses view credit insurance as a key tool when they start seeing the economic conditions deteriorate, especially in such an uncertain situation like the pandemic. I think people didn't know what was next, and they were really looking for a partner that could help bring them that certainty.
Yeah, it must have been amazing. I mean, imagine being someone who sells beer to a concert venue and thinking, well, is there ever going to be a live concert ever again? And what's going to happen to my beer? No one's going to drink it.
Yes.
It must have been very, very tough. But in general, how does the kind of pricing cycle within trade credit tend to work within that economic cycle? Or are you much more steady than the rest of us who are all, you know what we're like, we're always up and down the mountain?
I would say I don't have a lot of personal experience in other insurance lines, but I would say based off of my 21-year experience, we have pretty stable pricing within credit insurance. Obviously, when there is an economic deterioration, prices tend to increase, but not significantly. I would say 10, 15% at most during probably the most heightened, uncertain economic times that I've seen in my experience. But in general, we've been in a relatively soft market for a prolonged period post-COVID. So government measures, especially in Europe, kept insolvency rates relatively low during COVID and post-COVID. Mm-hmm. And claims have been stabilizing in the past couple of years, but we really haven't seen a significant increase in loss ratio across the market dating back years. And this has allowed us to maintain rate stability. We've also seen a number of new market entrants entering the space, not so much our direct competitors within Allianz Trade, because we provide solutions from micro SMEs to multinationals, but we do see other competitors coming in and offering, for example, some capacity here and there, which has also kept rates low. But I think it's very fair to say that the risk environment is here and discipline is increasing. So we've been able to maintain our technical pricing discipline all while supporting client growth.
And in general, you're feeling that rate adequacy is there and you can get the rate that you feel you need to produce the margins that you feel the business requires?
Yes, we can. And keep in mind that credit insurance is a very capital intensive business because of solvency requirements to have capital set aside. We at Allianz Trade have over €1 trillion of exposure that we write. And that requires, a hefty amount of capital to set aside in the various regulation environments in the different countries. And that requires pricing adequacy. And I think that does a good job in keeping prices stable as well.
Do you think if there's any trend in that pricing adequacy, is it trending to be slightly better or is it trending to be slightly not so good?
I think we're at a low point. I don't think pricing will get much lower than it is now. And as I mentioned before, we are expecting to see an increase in business insolvencies and a return to normal claims environment. So I do think that rates might increase, albeit slightly, in the years to come. That would be my personal forecast.
So on the economics, we're just sort of past the peak of the interest rate cycle in most places, and UK is just eased for the first time, US just about to. Is it generally something that it lags a bit? Nothing happened while interest rates rose reasonably sharply when inflation came back. And then is it really all about a lag, that there's often a lag on the companies that are being affected? It's when they get to refinance or those kind of things.
Exactly. So, for example, you made comments about interest rates. In the UK, when we saw inflation increase, we saw interest rates significantly increase post-COVID. It takes time for that to trickle down into the businesses because obviously their financing comes up for renewal and new terms are negotiated. Likewise, when interest rates start coming down, the same effect happens, right? It takes time for businesses to refinance and for them to feel the relief. In the UK in particular, I think it's not just about the interest rates that have been challenging businesses, but also just the changes around some of the tax implications for businesses that have been put through recently. Businesses are facing increased cost pressure across the board. So it's a challenging time for them. As a credit insurer and in general, what we must do is be ahead of the market, right? We need to see and anticipate what's coming, because it takes a while to change, right, and to implement a different risk strategy. And again, we need to do it slowly and responsibly to make sure we're creating stability for our clients and for our business. So what's really important is how we anticipate the trend emerging and how far ahead of that we are. Likewise, we can start opening up on capacity and credit even when things are still pretty negative because, again, we're anticipating a rebound at the end of the cycle.
So in terms of that, obviously, there are always sectors that are doing better than others. There's always one sector of the economy is always under pressure and others seem to be booming, doing great. And it's the same with varying geographies. Where are you feeling there's the most pressure? Which sectors and geographies are the most difficult at the moment?
I would say in terms of geographies where we see political instability and FX fluctuation, these are probably the areas where there might be continued concern. But when we talk maybe sector-wise, we are watching the automotive sector very closely. In automotive, obviously, we know that there's an exchange from combustion to EV vehicles and the rare earth materials that are used in traditional combustion engine car manufacturing, and even more so for batteries and electric vehicles. There's a risk of a shortage for these rare earth materials. Obviously, we have the potential trade tariffs that can cause inflationary issues. There are diverging political directives around carbon policy, so that Europe being much tighter, for example, than the US. Consumer concerns over range and charging of network for electric vehicles. And Mark, what I can tell you is I am most recently a fully electric vehicle car owner. So I left the US with a fully combustion car, and I didn't have a car in London because you obviously don't need one. And I returned to a fully electric vehicle, and I know the concerns around range and the network for EVs. Yes, battery anxiety is what we call it in my family. But this is a real thing, and it does impact consumer confidence around electric vehicles. And then, of course, with electric vehicles, there's increasing competition from newcomers, right? They can be from the tech industry versus the traditional car companies.
If someone who's a traditional large combustion engine manufacturer, a household name, it must be very difficult for them to manage that transition, that change up in demand and that change up in their own supply and rearranging their whole supply chain and product base as well. Yes, again, it must be something that's pretty difficult. They're going to put companies under pressure.
Absolutely. And we see this in other sectors as well. In the UK in particular, the steel industry making the conversion from traditional steelmaking methods to more carbon-friendly, carbon-neutral methods. This is a very costly transition. So it's almost better to not have the weight, the existing traditional heavy business model. And this is where new competitors in this space, in the automotive sector, are taking advantage of the opportunity.
You were saying about construction. Anyone who knows construction, there's always credit problems in construction, always, because of so many different supplier relationships and always come with the territory.
Yeah, I think, with construction, it is a really challenging sector. The higher interest rates and tighter financial conditions, they're just still weighing on demand. We see, obviously, challenges with higher cost for materials being put into projects, and construction businesses either have leverage to pass on those costs or don't. And the ones that don't are often the ones that get stuck and have the most challenges. So it's really a sensitive industry. It's also the largest industry in the UK and for credit insurance, not in the US, but by far and away the sector that is most likely to purchase credit insurance, which is probably not a surprise. But the point is that there are good companies in any sector, right? There are good automotive companies, there are strong construction companies, and it's really around the ability to differentiate the risk at a granular level with the data.
So in the really big picture, you're absolutely of the world and part of the world. And you already mentioned about the tariffs. And of course, that interaction between the political and the economic. Again, it looks like you can't ignore what's happening in the world at all, can you? Again, you talked about political instability. Again, this is another factor. So again, it looks like you have to almost be politico-economic analysts, don't you? In some way, you have to have this really holistic view. Is that the right way of looking at it?
Absolutely. And I would go so far as to promote here our economic research department. We have one of the leading economic research departments across the industry. And I would put that not only in insurance, but financial services. And they are constantly monitoring data that's put out by governments, by other institutions. They're doing their own trade surveys, for example. So we have in-house capability to really make sure we have a strong handle on the risk.
What I like about the way you describe the business is the way that you are so embedded with that customer. Again, you're sort of effectively the CFO's best friend, or that finance department's best friend, that credit control department's best friend. You're there, you're fully partnering with them all the time, letting them know about different companies, about how this one's doing fine, this one's not doing quite so fine, and this one needs you probably have a bit of a question mark against. Again, it sounds like a huge amount of work and a lot of presumably technology has been a real friend for you, and presumably in order to deliver to particularly very small businesses, you would have to invest a huge amount in technology, one presumes. Would that be right?
Yes, absolutely.
Are you something that CFO can log on to and say, right, these are my suppliers, this is a thing, this is what Allianz thinks about them, this is what's changed, this one's been upgraded, this one's been downgraded, or whatever?
Exactly, Mark. You touch on a really important part, which is unlike a lot of other insurance lines, I won't say all, but I think unlike most insurance lines, we have almost daily interactions with our customers. Because keep in mind, the policy is a living, breathing thing, right? They come to us at the start and they become our customer. We set up commercial terms in terms of the policy, and then we underwrite credit limits for all of their customers that we will insure them up to a certain level in the event of a non-payment event. But the levels of credit needed on those customers change. Most typically, they submit requests for increases. We will also monitor their customers and let them know if there's any that we need to decrease the credit limit because there's an increased risk of their customer not paying. But on a daily basis, they're also getting new customers that they're adding to the policy. So this creates a very high touch point interaction with our customers and with the brokers that we work with. And we have interactions, obviously calls and emails with our customers, but they can also administer their policy through our online portal. And we have API connectivity with a lot of our customers as well, especially those large multinationals that have large amounts of data, and API calls just creates much more efficiency. So given that, the high touch point and high interaction we have with our customers, and also the vast amount of data that we have, technology is critical. Automation, all of this is so important. It allows us to really scale our business. And we continue to innovate and leverage machine learning and AI to process vast amounts of data about companies and macroeconomic data. And this really helps us detect early warning signals.
So it sounds like, again, you would have been early appliers of AI technology, for example. What have you found to be the best applications, the best use cases for AI? Because, of course, if you're trying to monitor 90 million companies, I don't think you can have 90,000 analysts doing 1,000 each, for example. Just even the thought of doing 1,000 companies, I mean, that'd be quite a lot. Even that would still be 3 or 4 a day, wouldn't it? Even if you had 90,000 analysts, and I don't think for a minute that you do. So you must be using technology.
Indeed. So specifically around AI, we have used AI to help us enhance our existing automation models. So we had automation models for many, many years, but we're using AI to help enhance those models and more specifically to process mass amounts of data to detect correlations between the data that we might not have seen in the more traditional models. And what this is all doing, Mark, is it allows us to really deliver a better service to our customers. It does create the ability for us to automate and to be faster and more efficient with our own internal tasks, which again allows our very capable, very experienced credit teams to spend more time talking to customers, which is what we know that's what our customers want, right? They want the personal interaction. So yeah, AI continues to be a very important part of our business. And we actually did a global trade survey, and I have to maybe pull the stats, but of the 4,500 businesses globally that we interviewed, I think upwards of 90% of them confirmed that they were making investments in AI to run their business. So it's very prevalent in all sectors, and I think it's gaining momentum.
Do you think there'll ever be a point where you let some AI, agentic AI, hold the underwriting pen because it's done all the analysis and said, right, I think with this one, we need to charge more here?
I think AI will always help us make decisions, but it will never make decisions for us. You need a brain, right? You need the human interaction to understand the data and to make those decisions. So I think AI can be used as a tool, but very much it will not replace what we do and the people that we have in terms of making the smartest decisions for not only our business, for our customers.
One thing you mentioned about brokers, how much of the business is brokered and how much isn't?
Yep. So we distribute our product globally through, I would say, really 2 main channels. The first is, of course, brokers. And there are definitely specialist brokers in the trade credit insurance that you would find across the world. And there are also general brokers or P&C brokers that also distribute our product. When we work with general brokers that aren't specialists in trade credit, we oftentimes pair them with Allianz Trade employee, a direct sales agent, to help steer and to guide them, because there isn't always the same level of awareness at the start of the relationship that the broker needs to feel comfortable to sell the product. So we help that. So we have direct sales agents that also sell directly. These are most often than not middle market to SME customers. So brokers, direct sales agents. We also have a couple of partnerships with banks that might identify some of their customers that could benefit from credit insurance and would refer the client to us. We have attempted to digitally distribute, not only within Allianz Trade, but within other participants in our industry. And I will say, Mark, it's a challenge. I'm not sure if credit insurance is well enough understood to be a product that can be purchased outright on a digital platform, but maybe time will tell and we'll see.
And that human side of it, you do need that broker, all those other relationships, those other professionals to be out effectively explaining and selling your product on your behalf, it sounds like.
Yes, and there's a lot of advice and consultation to actually administer the product as well. That's where a lot of the value is. And that's very difficult to put purely through a screen to convey that to a client.
And what you were saying about digital, I'm sure the acquisition costs on that are way higher than actually using a broker.
The amount of money to promote a platform to sell credit insurance, the economics probably wouldn't be as smart right now. What is interesting to see is the move in businesses investing, because search engine optimization has been like the key marketing spend for the past 20, 25 years, and how businesses are starting to look at large language models or AI in place of that traditional SEO spend. Yeah. So I think that's another space that we're watching from a marketing perspective that I find fascinating. If you're a business owner, are you going to go to a search engine and search what is credit insurance, or are you going to ask ChatGPT, for example?
ChatGPT might become your best broker. Who knows? Yes, it's certainly possible. Yes. Because it's something that does require quite a lot of dialogue. And if you're asking ChatGPT how to improve your returns as a company, it might say, well, have you used that leveraging capability of leaning on trade credit? You won't need quite so much of your own working capital if you use it. So yeah, you could improve your return on capital, couldn't you, easily? So again, it might be something that ends up in the model, that ends up, sitting in a large language model, and therefore it could be doing a lot of good marketing for you. But I suppose even at that point, you still probably want a broker on your side to kind of hold your hand and really show you where the value is.
Yes, absolutely. Especially B2B purchasing. There's typically some self-information phases, right? At the beginning, watching videos, maybe asking your AI platforms, your ChatGPTs, doing some Google searches or whatever it might be. But then you would more often than not contact the company directly or contact a broker, even if it's your existing broker for property and casualty or maybe a specialist broker.
Yeah, absolutely. I think that's probably still going to be the channel for the foreseeable future. But it's very interesting, certainly when I've spoken to some brokers and actually some carriers on the program recently, and when I'm asking, what are you using AI for? And maybe a year ago, it would be, it's all for the low-hanging fruit kind of stuff, the ingesting a whole load of dumb data and trying to structure it for us, and saving us a lot of time. And now a lot more of it is a lot more on the front foot, a lot more sort of going out there. And actually, in the last few episodes, I've had a couple of instances of people saying, well, we're using it to help target customers, like actively, almost aggressively target customers, or as if it was a carrier, to target the brokers that we know have got the customers that we want. And to the point where we're giving them a very rough indication of, we're actually pre-quoting those customers from all the information we already know about them. It was rather interesting. I don't know if you're going to go that far, but again, it sounds like you've already been experimenting with some of that.
Yeah, exactly. That's definitely the case.
Excellent. Sarah, thank you so much for your time. And again, please forgive all the sort of slightly educational kind of credit insurance 101 type questions I've thrown in there. But I've really enjoyed talking to you. It's been really enlightening and educational, and also just fascinating in itself. So thank you so much for giving up your time and coming on The Voice of Insurance.
Thanks for having me, Mark, on The Voice of Insurance. And after spending 21 years in the industry, I continue to learn every day, and I'm happy to talk to anyone about trade credit insurance that wants to listen. So really appreciate the opportunity to be here.
No, I really enjoyed having you on the show. Thank you so much.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.